Central banks are the cornerstone of any country's financial system, performing several key functions that support the overall health of the economy. Their primary responsibilities include the formulation and implementation of monetary policy, the management of national currency reserves, and the regulation and supervision of banks and financial institutions. Monetary policy, managed by central banks, is a critical tool for controlling inflation and stabilizing the economy. Through open market operations, discount rates, and reserve requirements, central banks can influence the availability and cost of money, thereby affecting economic activity. Furthermore, central banks act as the lender of last resort, providing liquidity to financial institutions during times of crisis. This function is crucial for preventing the collapse of banks and maintaining confidence in the financial system. Monetary policy and interest rates. One of the central bank's most influential roles is the control of interest rates through monetary policy. By adjusting the interest rate, central banks can influence the cost of borrowing and the incentive to save, which in turn affects consumer spending and investment decisions. For example, when a central bank lowers interest rates, borrowing becomes cheaper, encouraging spending and investment, which can stimulate economic growth. Conversely, raising interest rates makes borrowing more expensive and can slow down economic activity. Central banks use this tool to prevent the economy from overheating and to control inflationary pressures. This delicate balance is essential for maintaining a stable economic environment. The control of interest rates is also vital in managing the exchange rate of the national currency. By influencing capital flows, central banks can affect the value of their currency in the foreign exchange markets, which has implications for trade balances and international competitiveness. Central banks and inflation control. Inflation control is one of the primary objectives of central banks. High inflation can erode purchasing power and create economic uncertainty, which can negatively impact growth.